All right, let's get right into it. We're breaking down the latest earnings call from Educational Development Corp, ticker EDUC. And really, the story here isn't about explosive growth. It's about a company in survival mode, trying to stabilize the ship. So the big question is, are we looking at financial triage, or is this the beginning of a genuine turnaround? Let's find out.
Here's how we're going to tackle this. We'll start with the headline numbers, the good, the bad, and the ugly. Then we'll walk through management's three-step plan to right the course. After that, we'll see how the market reacted, what key catalysts you absolutely need to have on your radar, and then we'll give you our official rating and a pretty interesting speculative trade idea.
First things first, the numbers. And, there's just no way to sugarcoat this. It was a really tough quarter for these guys.
So, for the second quarter, revenue clocked in at $4.62 million.
But that number by itself doesn't tell the whole story. The really critical piece of data here is the trend. That's a 29% drop from the same time last year. It shows the sales decline is actually picking up speed, which is not what you want to see.
So why the big revenue drop? Well, this number right here gets to the heart of the problem. Their direct sales force in the PaperPie division, they call them brand partners, shrank to an average of just 5,800 people.
And wow, this just lays the problem bare. That sales team has collapsed by 58% in a single year. You just can't run a direct selling business when you're losing your sales force at that kind of rate. It's simply not sustainable.
Now, okay, amidst all that tough news, there was one little glimmer of hope, a sign of some operational discipline. The company's net loss actually got smaller. So what this tells us is that even as sales were cratering, management was hammering down on costs, trying to find a floor. So, what's the plan to fix all this? Well, right now, their strategy is pure financial triage. They're focused on stopping the bleeding so they have a fighting chance to actually heal the business down the road.
And it's a pretty clear sequential plan. Step 1 is the big one. Sell their main real estate asset, the Hilti Complex, and use that cash to wipe out all their bank debt. Step 2, keep cutting costs and whittling down that inventory. And only when that financial foundation is solid can they even think about Step 3, reinvesting in tech to rebuild their sales force.
Now, this right here is where it gets really interesting. It's an explicit pivot in their whole strategy. The CEO, Craig White, basically admitted their tech is clunky, and they're now zeroing in on a completely new demographic of sellers. They know the old playbook is broken, and this is their big bet on the future. And here are the specific cost levers they're pulling. Just getting rid of that bank interest is a huge boost to cash flow. They're also planning to stop all the heavy discounting they were using to raise cash, and they figure they can save about $1 million a year by getting out of rental warehouses. It's all about becoming a leaner operation.
Okay, so that's management's game plan. But how did the market, the ultimate judge, right, react to it all? Well, with a whole lot of skepticism. This is what we in the business call a show-me story.
This slide really just nails the disconnect. You've got management painting this rosy picture of a clean balance sheet and a clear path to profits. But the market is looking at the free-falling revenue in Salesforce and basically saying, yeah, prove it. Management might call their bank default a formality, but for investors, that is a massive red flag that stays up until the ink is dry on that sale.
And, well, the market delivered its verdict pretty fast. The stock dropped almost 10% on heavy volume the day after the call. Investors heard the plan, but they voted with their wallets, sending a clear signal that they need to see actual results, not just promises.
All right, so the company's in triage mode and the market is clearly skeptical. What are the make-or-break events that we all need to be watching over the next few months? What's going to decide if this whole turnaround actually works?
Here is your checklist. Number 1, and this is by far the most important, is the closing of that Hilti Complex sale. They're targeting mid-November for that. Number 2, we need to see proof that all the bank debt is gone. After that, we need to see if those brand partner numbers finally stabilize over the holidays, and if we get any real data on their new tech and recruiting efforts.
So, time to put it all together and issue our rating. When we weigh the immediate need for financial triage against this long-term, unproven turnaround story, where do we land?
Our rating on EDUC is market perform.
And here's why. The bull case is simple, but it's powerful. If that asset sale goes through, you've got a debt-free company with a clean slate. That takes a huge amount of risk off the table. But the bear case is just as strong. The core business is falling apart fast, and their entire growth plan hinges on a tech pivot that, right now, is pure theory.
The risks and the potential rewards just feel too balanced. And that's why we're at Market Perform.
All right, for our last segment, for those of you with a higher appetite for risk, we're going to lay out a trade idea that's, well, a bit outrageous, but it's also plausible. And it's based on the very specific timeline we just talked about.
So the key question is this. With such a clear make-or-break event just around the corner, how could you possibly structure a trade around that one specific catalyst?
Here's the pitch. A catalyst-driven long position. The whole idea is to get into the stock before that mid-November target date for the property sale. The theory is that the market is still pricing in a very real chance of bankruptcy. If that sale closes and that debt is officially gone, the stock could see a massive relief rally just because that existential threat has been removed. It's a binary bet on a single event in the very near future.
This is not financial advice.